You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of The Options Playbook. All right, we usually start by looking at last week's trade, but we had a derivative of Options Playbook Radio last week in that we actually looked at an adjustment in our stock play of the day trade for the week. And I even mentioned on the podcast that the adjustment may not come to fruition, and it actually did not, in that we looked at rolling a butterfly into a short spread. This was using puts, so you went from a put butterfly into a short put spread. And just kind of talked about the adjustment, how the roll would go, when you would do it. Bottom line is the market never really made a big rally going into the Friday of last week when the Fed chair, Mr. Powell, spoke and gave his comments from Jackson Hole, which the market took as a negative. He said painful a lot, and I guess that was the big buzzword from his speech, and the markets were painful for the day. So as far as being long a put spread on that Friday expiration, that was a good thing. So I wouldn't have wanted to adjust that trade. But we'll look at more trades like that. That's one of my favorite little nuances to do in the marketplace. If I am long a butterfly, the potential to roll it into a short spread, or if you are long just long a spread in general, maybe rolling it into a butterfly or even short a spread. So I'd like to go between butterflies and spreads into butterflies, et cetera, et cetera. So that's what last week's podcast was about. And it was a tough one to follow because we don't have any, the graphics aren't the best here on my podcast, Options Playbook Radio. So because of that, you really needed to look at the Tuesday trade and then look at that adjustment. So this week, once again, I'm just a little bit nervous about the marketplace, and it's only because of seasonality. We have September, we have October coming up. Because of September and October, those are usually the most volatile months in the marketplace. We had a down day today, very little bit down. And I should let you know that we are taping Options Playbook Radio. It is Wednesday, August 31st, and the markets are closed. And we had the Dow Jones Industrial Average and the SPX down a fraction today. We had the VIX up as usual. But more importantly, we're seeing the VIX hanging out around the 25 level. And because of that, it's just, I think that's where the VIX should be. I thought 20 was too low. There was quite a bit of complacency. And I think if you were going to call Mr. Powell's comments, as opposed to saying irrational exuberance, he said that there is still a lot of pain to come as far as trying to get inflation tamed. So I think painful would be his word relative to irrationally exuberant. And that word was taken pretty seriously. The Fed is still taking inflation head on. We're not even close to the 2% level that the Fed would like to see. So they're thinking now. If you look at the Fed Watch tool over at the CME, you see that we're leaning towards a 75 basis points hike here in the next meeting, which is coming up in September. So we've had fairly strong markets in at the end of July and August, leading into September. September, seasonality wise, is one of the only months of the year, if you go all the way back to 1950, that actually has a negative return in this month. Now, that doesn't mean to me that that you should go on out and sell every one of your stocks or any of your index funds that you have. I always kind of preach, especially if you have the ability to go a little bit long term, that is your outlook. This doesn't necessarily mean that every month in September has always been a negative. It's saying it's very little bit negative over if you combine all the years going back to 1950. So I'm going to talk about hedging strategies today. We're going to look at a stock like Amazon, which used to be really hard to trade options on because it was such an expensive stock. Went through a 20-for-1 split, and Amazon today is trading at $126.77. It was down $1.96 on the day. So you maybe a day late and $1 short, because we did have a fairly strong move to the downside. Actually, the last couple of days, tech has gotten beaten up. So what we're going to talk about, we don't talk about that often here on Options Playbook Radio, but it's probably one of the most popular option strategies that I know of, and that's just selling a covered call. Now, if you had 100 shares of Amazon after they went for their 20-for-1 split, you now have 2,000 shares of Amazon, and that means you could take some of that position and maybe try to hedge by selling a call against it. Now, as always, nothing here on Options Playbook Radio is meant to be a recommendation. So we're going to look at two different trades here. We're going to look at the simple, straightforward selling of a call on 100 shares of Amazon. You can decide how many shares you would want to sell it on, if depending on what your portfolio would look like, or even if you owned Amazon. If you don't, maybe you own Apple, maybe you own Google, maybe you own some of these other mega cap stocks that are getting a little bit beat up here in this inflationary environment, and you don't really want to sell them. You have maybe some capital gains still in them, hopefully, and this is one thing that you might do if you are very nervous about the fact that we're coming into the September and October timeframe. So to start with, let's go out and pull up a chain on Amazon. And once again, you can pick the stock that's inside your portfolio that you may want to do this on. So I'm going to the Ally Invest option chains. I see that Amazon last traded at $126.77. As I mentioned, down $1.96. If I was just going to sell one call option, I'm going to have a much different approach than if I'm doing a short put spread or a short call spread. On my call options on a fairly volatile stock like Amazon, I'm worried about September. I don't want to go that far out in time. I'm worried about getting pegged on the upside, and I'm not necessarily doing this because I want to sell the stock at the higher price. I'm looking to try to manage this position, hoping to bring in some premium here in the short term. So in our paper trade this week on Amazon, we're going to look at selling one call option for every 100 shares that you have, and you determine how many of those shares you'd want to do. And we're going to go out to the September 16th time frame. So we're going out 16 days, and there's no earnings. There's nothing major as far as news is concerned. We do have holiday seasons. A lot of people are talking about holiday shopping already, and you never get. There's a lot of news that's around the retail space, Amazon obviously is a big retailer, but one of their biggest businesses is their web service. So they're a much different beast than just a retailer. With that said, I want to avoid earnings. If I knew there was earnings coming before September 16th, I wouldn't consider doing this covered call strategy. I'm doing it because right now earnings are anticipated to be in the end of October for Amazon. So I'm going to go out 16 days and I'm going to sell a call a little bit out of the money, trying to bring in some decent premium to my account. So the call that we're going to be selling against our 100 shares of stock would be the September 132 call option. I'm currently seeing that trading at $2.07 by $2.12. When you're selling individual options, it's a little bit harder to get a midpoint fill on it because you're not giving the market maker both sides of the trade, a buy and a sell, like you would be in a spread. So we're going to say that our midpoint on that trade would be $2.07, or I'm sorry, the bid is what we would hit. And that would be our paper trade this week. Simply, we're going to go out to September 16th expiration with Amazon at 126.77. Look to sell the 132 strike call, bringing in $2.07 or $207 less commission. Now, I would probably continue to do that. I would do that if I'm really nervous about September and October after this option contract expired. If the stock was still basically trading where it was at and I didn't get out of my stock position still, I would look to maybe sell another 16-day call option. With the advent of weeklings, there's a lot of flexibility in that. And that's the way that I would approach it for these months. And I would do it on on other stocks inside my portfolio also. Talked about that a little bit on a couple of different podcasts that I was on just a couple of weeks ago. But this is a simple trade. I want to manage the risk. I don't necessarily want to sell my quote unquote Amazon that may be in my account. But I'm looking to bring in some premium to try to offset that risk. And if it does get up to that strike price, 132, say in the short term, over the next 8 days, I'm going to look to either close it out and say, all right, I was wrong. I'm glad that the market went up because I made more on my stock than I lost on my call option. Or I would look to roll it. I'd look to buy it back and go up and out in strike. But I want to set an alert for 132. I don't want the stock to blow through that 132 level if I can avoid it. Whenever I'm looking to roll a covered call position, I usually am going to do it when the stock gets fairly close to that strike price. Now, obviously, timing to expiration is important. If it gets there sooner than later, I'm definitely going to look to roll. But near that expiration date, it's kind of flipping a coin. Do you think it's going to be in? Do you think it's going to be out? How bad do you want to keep that stock and avoid that assignment of that short call option? All right. So that's a simple trade. And I mentioned it because in Amazon because it was really hard to do these type of trades in Amazon when before the 20-for-1 stock split. So now it's very feasible that people may have 100 shares of Amazon in their account. Not that it wasn't feasible before, but that would have just took a large chunk of change prior to the split. And that also happened in Google. So you may take this concept, apply it to Google. Apple, before their split, was kind of similar. Now they've been trading after the split for quite some time. But Amazon got fairly close to an all-time high. And now here, once again, we're going into September and October, and we see some weakness in the marketplace. So my other trade that I would talk about, just because a short call option or a covered call on Amazon is fairly short and sweet. Let's give you a bonus trade this week. We're going to go out and actually look at a collar. So if I was more nervous going out longer in time, I would consider doing a collar. And that means that I am basically just going to sell a call to help pay for my put. So now I'm more nervous on Amazon. I want a little bit longer protection. I'd like to try to get out to the end of October, or basically fairly close to when they may be announcing earnings. And I'm going to look at the expiration that I have in front of me is the October 21st expiration. So I am going to do the 5% deductible. So 5% with the stock at 126.77 is going to be about 6 points. So we would look at the 120 strike put. So if I buy that put outright going out to October 21st, well, that's going to be fairly expensive. Amazon's got a little bit of volatility in it right now. We're talking about maybe a 40% implied volatility, which is a little high overall in Amazon. Well, not high recently, but high prior to the pandemic, if you want to say it that way. With that said, so the ask price is $4.70. The bid price is $4.60. So if I add that to the 6 point deductible or $6.77, now you're looking at a 10% downside on the underlying stock. So to me, I would say, well, maybe I'll just wait and I'll just sell it if it goes down 10% as opposed to paying so much for my protection. So how can I get that cheaper? Well, let's go to the opposite side. Let's stay on the same expiration. We're going to get more premium for it, but we're going to look at the October 21st expiration and we're going to sell the 135 call. Now we can go a little bit further out of the money on the upside and get fairly close to the cost of the long put option. So I'm looking to sell the October 21st 135 strike call. That is right now with the markets closed, bidding 410 and asking 420. So our put option, 5% or a little more than 5% out of the money is 460 by 470. Our call option that we're going to use to try to pay for our protection, pay for our put option, is trading at 410 by 420. We have the underlying stock at 126.77. We're giving ourselves a little bit more upside before that obligation to sell as opposed to the downside. But the situation here is that we're actually going to be paying a small net debit to the account. Now, the total net debit, if let's pretend you have 100 shares of stock already and you're putting this collar on, would be a net debit of 50 cents at the midpoint to your account, or 50 cents plus commission, $50 plus commission for that 100 share position of Amazon that you have in the account. And a lot of people like to reference this as a zero cost collar. They like to try to get everything summed up so that you can get it done for zero, or basically you don't have any outlay of cash. That didn't quite work out. I think I would rather do this, give myself a little bit more upside and pay just a small dollar amount. So this is a 50-cent collar if you want to put a name to it, I guess. And that would be a different alternative. And once again, you could use this in any other stock that you would consider. Now, on the downside here, we got that protected put. If it goes below 120, I can take the whole collar off. I can buy to close the call, sell to close the put, and be just fine. Or I can just sell to close the put, because if it's gone down, well, now that call is way out of the money, and just let that time decay affect our longer term call and maybe just sell it to put. But bottom line is I'm not forced to sell the stock here unless I let the stock run above 135 and I fall asleep and I get assigned on that 135 call option, which just means I sold my Amazon a little bit less than 9 points higher. That's simple. That's straightforward. Okay, so 2 paper trades this week. Just looking at selling a 16-day call option, selling it a little bit out of the money, bringing in a decent amount of premium. And if that expires worthless, maybe doing it again. We're nervous about September and October. We've had a little bit of weakness in the marketplace ever since Mr. Powell spoke in Jackson Hole last Friday. And September says that we should be nervous based off of the historical months. But once again, history does not guarantee future results. So I guess that's worth saying. And then our second trade of the week is if we are long Amazon, stocks at 126.77, maybe buy a protective collar. We're going to buy the 120 strike put and at the same time sell the 135 strike call. Doing this, trying to get this all done for a net debit to the account of 50 cents plus commission. All right. Thanks for coming, everyone. If you have any questions or concerns, please email them directly to me at theoptionsguy@invest.ally.com. If you'd like to learn more about what we do educationally, please follow me on Twitter. My handle is @BrianOverby. And that's it for this episode of Options Playbook Radio. We'll see you same time, same place next week. May all the options you bought finish in the money and all the ones you've sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.